Hi there, welcome to Kneppy Invest. Time for a technical update. And in today's technical update, I'm going to be focusing on 21 ASX companies. Yes, 21. Actually, it's 20 ASX companies. One company on either the Nasdaq or the New York Stock Exchange. And the only reason I'm including this company is I put it or planned to look at this company, and then the share price fell 23% overnight because the company did release fourth quarter results, but I think the share price fell for that company because of their financial year 24 outlook with significantly lower growth than the market was hoping for. Also have a look at the XJO, the Nasdaq, and also the Dow Jones. Things are looking interesting right now. And first up on the screen is the XJO, which is the ASX 200. And if you take, this goes back to about October of 2021. So we're almost 18 months of history here. And if you just get rid of all the peaks and the troughs, the XGO has just gone sideways over the past 18 months. It's been really struggling to get above 7,600. In fact, almost a triple top, not quite. The XGO almost got to 7,600 at the start of February, got to 7,560, got to 7,600 back twice in 2022. First time was in January and then again in April. And the low point for the XGO has been around about 6,400, and that was reached twice. First time was in June, then again in September, and a really big down day on the Friday because of what happened in the United States. And in fact, the XJO was down 2.28%. One of the biggest decreases we have seen in a long time, in fact, since maybe June last year. That's my birthday, 14th of June last year. Maybe there was another time, day bigger than that, down day bigger than that. But looks like the worst day on the XGO or for the XGO since my birthday, 14th of June, 2022. Now, I wasn't born 2022. That was my birthday. If we look at the weekly, now the XJO is still trading in this range that has been going on since the GFC, and right now it's in the middle of the range. So that range, or the top of the range, is around about, or just about 7,800, and the bottom range is about 6,300, which would be very close, or could be getting very close to that triple or double bottom we saw at 6,400. Now, the XJO hasn't fallen below the bottom of this range apart from once during the COVID-19 financial panic, and that's fair enough. And for only a very short period of time, back in May 2021, it actually went above the top of the range for one day. In fact, probably less than one day. So that's the XJO looking a little bit more, I wouldn't say it's bearish. When you look at the daily chart, it's actually been going up since those lows. But to confirm that we're in an uptrend, we need to get above the highs we saw back in February. So that means we need to get above 65.60. If we get above 7,600, that will be good news for those investors who are long with Australian shares on the Australian market. Now onto the Nasdaq. Now the Nasdaq did break out of its trend line. So there was a trend here as depicted or portrayed by this sloping dashed line. And every single time the Nasdaq hit that downtrend line, we saw the Nasdaq pull back. But it went through the top, or went through this trading range or the downtrend back in January, so late January of this year, and then kept going up. So maybe some people were becoming a little bit more bullish. And I have heard quite a few people, including experts, being a little bit bullish about 2023. One of the reasons they are bullish, and this is a justifiable reason, is you very rarely see two down years in a row. 2022 was a down year. So if we see another down year in 2023, that would be a very unusual circumstance. But if we just zoom in on the Nasdaq, we have seen this particular index under pressure. But still, I will not say it's in a downtrend anymore because that downtrend was broken. So what's going to happen over the next, say, month or so is going to be very important. What's going to happen in the economy, that sort of thing. If we see inflation remain elevated, that will be very bad news, not only for the economy, because they will continue raising interest rates. It would also be bad for the market. And even though some people say the economy is not the market is a subset of the economy. But I would say the market the Nasdaq, the XJO, Dow Jones are better than the economies for various reasons. Now to the Dow Jones. This is actually looking a little bit less bullish, possibly even getting into not quite bearish. But the Dow Jones also broke out of its downtrend line a little bit earlier than the Nasdaq. It broke out in November and has remained above that downtrend since then. But fair bit of weakness in the Dow Jones over the past few weeks. In fact, the Dow Jones has fallen from about 34,500 down below 32,000. And right now, at the end of trading on the Friday, the Dow Jones is just above that trend line. And sometimes, even if you do see a breakout in the trend line, the indice or the company can test that trend line again. And possibly that's what's happening with Dow Jones right now. So very interesting what's happening around the world in terms of markets. The very fact that Australia almost had its high back in, when was that, January again? Was that January? Let's have a go. February. It was early February. It is unusual that we almost saw the high in February when there is a lot of uncertainty when it comes to the economy. So possibly investors are looking ahead, which you should do because the market is always forward-looking. But I think there is a potential that we haven't priced in a possible significant recession, and we could be moving into a possible significant recession. Not a definite, just a possibility. Now on to companies. I did write some notes so I don't forget what to say. Not forget what to say, but sometimes I will see something differently. Now on to PointsBet Holding. Now, it's really interesting with PointsBet. In fact, we'll look at the weekly chart here first because I love this sort of chart. This is the Matterhorn. I call this the Matterhorn chart because it looks like the Matterhorn, sort of. And the reason I'm talking about the Matterhorn, I did rent out in Zermatt, if that's how you pronounce it, probably absolutely wrong. I did rent out a hotel room. It wasn't really a hotel. It was a little resort room with the bedroom overlooking the Matterhorn in the distance. Absolutely amazing, but you do have to pay for that, a fair bit of money. Anyway, a Matterhorn, and this is a very typical weekly chart you see for tech companies. In fact, PointsBet share price reached a high of $17.50, and the current share price of PointsBet is $1.46. If you go up to where there was an uptrend, there was 1 week here where the share price rose over 100% in 1 week, 106%. That was on the week of 24th of August 2020. A lot of froth in the market after COVID-19. You can just see that with PointsBet. And the share price continued to rise. The high for PointsBet was actually on the 15th of February week in 2021. So the top in PointsBet was well before a lot of other tech companies, and the share price has just kept on falling. The other thing you'll notice here, maybe my thing's in the way here. Another thing you'll notice here, when we had that really big up week, the volume was quite high. But over the past, well, since October 2021, we have seen really high volume weeks. And that's actually not a good sign. And that's why we have seen a lot of selling, or the share price down, is because there's been a lot of selling. And there's been a lot of selling just because of these fairly large volume of these big down weeks. So there was one in October, another one just a few weeks ago, actually 2 weeks ago. And if we actually have a look at the daily chart, and probably the other thing I should mention with this horizontal, is that horizontal? Yeah, horizontal dash line. That is the bottom of PointsBet during the COVID-19 financial panic. So keep that in mind as we look at the daily chart. And what's happened with PointsBet share price recently? Share price has got very close to those COVID-19 lows at $1. In fact, when the share price has fallen towards those lows, which we'll call now a support level, a fairly strong support level, because the market knows these are the lows for PointsBet during COVID-19. And we have seen this happen twice in the past few months. The first time was back on the 23rd of December, and we did see a lot of buying coming in. We know there's a lot of buying because the tail on that particular candlestick was quite long on the bottom side, low side of the candlestick, and the volume on that day was quite large. So that was just investors, maybe not investors, traders, seeing the share price get towards that support level and started to buy, but the share price kept on falling. And we saw a fairly similar scenario play out on the 28th of February. More than likely, this coincides with the company releasing their half-year results. Share price got to a low on this day of $1.05. So the previous day, the share price closed at $1.45. So a lot of selling. Share price was down big on that day. But again, we have a long tail to the downside, which tells us there was a lot of buying coming in during that day and pushed the share price up. And the share price actually closed at $1.30. And massive volume came through that day. We have seen continued pretty big volume follow through. The share price has gradually gone up, and the share price currently $1.46. So it seems like whenever the share price gets below about $1.30, a lot of buying comes in for PointsBet. And even though this company still has a market cap of $458 billion, it is still burning through lots of cash. It's a cash burning machine, PointsBet. Not the sort of company you want to own when interest rates are rising through the roof. Now to Xero, a company I've been following for the longest time, never had a position in this company. They released an interesting announcement a few days ago, all about reducing costs and disciplined growth. They are getting rid of 800 jobs. So this is the sort of thing the market loves to see. And why didn't they do this a few years ago? Not sure, because I do think a lot of companies, a lot of tech companies, when it's all about increasing revenue, are not disciplined when it comes to costs and that sort of thing. We are seeing that in a lot of tech companies reducing their staffing levels. So why did you increase the staffing levels in the first place if you didn't really need these staff? In fact, where I work right now, with, I won't say who, but probably if you go through my videos in the past, I haven't changed jobs or anything, they do the same thing. They do employ people where I just go, why are you employing these people? You don't really need these people. Anyway, the market loves this sort of thing. It always loves this sort of announcement where a company is showing they can be disciplined in their costs, and they talk about discipline and growth, getting rid of a lot of jobs. I don't like companies who employ a lot of people, because people cost a lot of money, lots and lots of money. I have seen announcements where people or companies not brag, but they do say, we employed this amount of people this quarter or this half, extra people this half. And I'm like, that's not a positive in my opinion. Not necessarily a positive in my opinion. Anyway, this chart looks a little bit more interesting. So well-defined downtrend, and it looks like potential breakout in Xero share price. Share price now at $86.73. Last time the share price was this high was September last year. So 6 month high in the share price. And the share price does look like it's potentially breaking out of this long-term downtrend. So this is a good sign for Xero, possibly moving forward. If we do look at the weekly chart, not quite the Matterhorn we saw with PointsBet, but again, share price did reach a high of $155. Does look like a possible almost triple top there. And the last time we saw the share price at $155 at the height was in October 2021. So just like every other tech company in the world, this company has been affected because they've been undisciplined in their spending. And now they're becoming more disciplined because they have to. They want to become profitable now, it seems like. Now onto the company that is not on the ASX. This is Docusign. Now, the one reason, and this is just like a PointsBet, Matterhorn, again, a lot of tech companies' charts look like this. Massive Matterhorn, beautiful Matterhorn. Now, the reason I decided to put Docusign in this particular video is I included it the day before Friday, so on Thursday. And this is the chart it looked like. So it looked like Docusign's chart was trying to move into an uptrend. So that looked like the lows possibly had been reached at about $40. Current share price at that point in time was about $66 or something. Then the company released their fourth quarter results. Share price dropped 22.8%. So I'm very happy that I did not buy Docusign just because I thought the share price might be moving into an uptrend. So I've mentioned here down 23% on the fourth quarter results. And I think this is just my thoughts. One of the reasons the market did sell off was because of very weak financial year 24 guidance, in particular revenue growth, fairly weak. Now, there is a potential that the management is being conservative in that guidance, and that would be good news for the share price moving forward, but the market did not like this particular announcement. Now, I'm also going to look at the weekly chart here because it's something really interesting. So if we go back to the Matterhorn, the other side of the Matterhorn, the I don't know what do you call that, the western side, eastern side, northern side, I have no idea. Anyway, there was a week, 29th of November 2021, where Docusign share price dropped 46% in 1 week. And you'll notice, particularly if we just zoom in, there was a bounce the next 3 weeks. In fact, the share price rose 7% the next week and another 7.5% the next week. The reason we commonly see these bounces after share price falls like this is because of recency bias. Recency bias is something you have to understand that the majority of investors have, the majority of people have. And when they see the share price fall like 46% for Docusign, they say, well, the share price now is significantly lower than it was before. I'm going to take a position in this company. That's why you do see a bounce. Now, that's not the only reason you might see a bounce. There could have been some investors who saw some value in Docusign at that point in time. But typically, when you just see a reaction from the market, down 46% in 1 week, that's not a good sign. And it's also a sign that the potentially sentiment in the company has shifted from positive to negative, and that could be the start of a downtrend. And the share price actually fell. In fact, at the end of that little bounce, the share price got to about $160. The share price kept on falling. In fact, the share price fell 75% from there. So don't always fall victim to recency bias. Just because the share price of a company might have dropped a significant amount doesn't mean it's necessarily good value. Sometimes it does, but not necessarily. And I am very wary of situations like this. In fact, am I including, I think I might be including Domino's Pizzas in today's video. Same sort of thing has happened with Domino's Pizzas, although we did not see a bounce. Share price just kept on falling after their disastrous results. Now on to Webjet. And we're not only going to look at a chart here, we've also included something else because I don't think a lot of investors understand that Webjet's valuation right now is its record valuation. So the share price right now is in an uptrend. It's moved into uptrend. Last time the share price got to $7 was way back in 2020 during the COVID-19 financial panic. So you can just see there, share price has got or did get above $7 in the past week. And you might say, well, before COVID-19, the share price reached a high of $12.50, in fact, almost $13. So there's a lot of room for Webjet to move. But the thing you got to take into account, the shares on issue for this company have more than doubled from 170 million to 400 million. So even though the share price is significantly lower than pre-COVID-19, the valuation, the markup of Webjet right now is its highest on record. And you can see that just by this interactive chart here. So what I've done here is the price of Webjet. Actually, we'll just look at the last 5 years, maybe. So the price, if you just look at the price, you'd say, well, there's a lot of room to grow for Webjet's share price because the record high was about $13 back in 2018. But if you overlay the markup on this, you can see, and I'll get rid of the share price, you can see that the markup right now is a record markup for this company because of the significant dilution this company went through back in 2020 because they had to issue a lot of shares to remain in business. That's why they doubled their shares to remain in business because they were not getting support from the Australian government. At that point in time, they weren't getting support. If I remember correctly, it was the worst timed capital raising because they did the capital raising almost at the bottom. Anyway, so don't fall victim to just looking at the share price. You have to also understand whether shares on issue have significantly decreased because right now, Webjet has never been so highly valued. So that's interesting, in my opinion. Anyway, on to Lindsay. In fact, we'll look at the daily chart for Lindsay first because this is a nice looking chart. And it's been a nice looking chart since July last year. Beautiful uptrend. Share price has increased from 40 cents to 80 cents. But the share price is really struggling to get above 80 cents. You can see the share price has reached 80 cents quite a few times since the start of the calendar year and just can't get above 80 cents. So it does look like 80 cents is resistance level. Now, the other thing to keep in mind with Lindsay Australia is whether the good times this company has seen over the past year, if it can last. And if you take a look at the weekly chart, just zoom out a little bit. So you can see if we go all the way back to 2015, the share price just went sideways. In fact, it was just drifting down from 2017 all the way through to 2021. So this is not the sign of a high quality company. When you just see the share price drifting down like this, going sideways, what you want to see is the share price generally going up through time. And then we've seen the share price really take off, double in fact, over the past, say, 6 to 8 months. And that could be an indication that this company has experienced some good times, some tailwinds, and a lot of times for these type of companies, tailwinds don't last forever. So just be aware, if you are a Lindsay Australia holder, just be aware that good times might not last long for a long time, and the share price could start falling at any time, particularly if the market becomes wary about the share price doubling in a short period of time. But maybe the company has turned a corner, and maybe the good times will last for a while longer. And I have seen this before with companies, but usually it's better quality companies. A company like Medicus, a company like, there's another company I'm thinking of, where Altium. It's a classic example. So let's go to Altium, ALU. Altium, oh, it's an extra company. So beautiful chart. So if we go back to the period between 2007 and 2012, share price of Altium was drifting downwards. So this company quite hadn't made it at that point in time. They hadn't reached their inflection point. And then the company reached their inflection point in 2012. And from then, look at that beautiful chart. Look at that upswing in the share price. But I wouldn't compare Altium to Lindsay Australia. I don't think Lindsay Australia could be classified as a high quality company. And for high quality companies, we want to own them as long as possible. Because sometimes for high quality companies, good times can last decades and decades. And I don't think that's going to happen for Lindsay Australia. So let's have a look at Pentanet 5GJ. And in fact, we'll have a look at the daily chart. All I want to show you for this, there was a really interesting day for Pentanet on the 7th of March. Share price only rose 9%, but the share price reached a high, because the share price closed at 18 cents, but the share price reached a high of 27.5 cents on that day. So obviously there was some good news for this company. Unfortunately, because the share price is in a well-defined downtrend, there's going to be a lot of resistance for the share price to be moving higher. A lot of supply came on market, supply came on market because of this particular day, share price getting up to 27.5 cents. So a lot of shareholders who bought in sort of this area here between May and December last year at a higher share price, they saw the opportunity to sell out. That's that extra supply coming onto market. And that's why Pentanet share price struggled to remain at those levels, because of that extra supply coming onto market. You'll notice every single time Pentanet share price gets up to the 150-day moving average, I like 150-day moving average, share price has struggled. So we saw that in July, share price got to 150 days and then pulled back. We saw it again in November, share price got to the level and then pulled back. And we saw it again on this day, the 7th of March, share price actually went above the level for a short period of time and then has pulled back. Share price has dropped all the way down to 14 cents. So one point in time on that day, share price did reach a high of 28 cents. Share price has halved since that day because of the selling. I've seen this a lot over the past few weeks. When a company has released a good announcement, the market has reacted really favorably on that day, but then the selling comes in. A classic example of this is MoneyMe. MoneyMe. Oh, another company. Beautiful example of, look at that. Look at this. So the share price of MoneyMe increased 64% on one day on pretty good volume. Then the selling came in because the share price was in a downtrend. So always be wary of all that extra supply of those investors who bought in at higher share prices in the past. They want to sell out because the majority of shareholders want to see the share price of a company they own, they just bought, to increase almost automatically. If they see the share price fall, they assign the tag dog stock to that company and they just want to sell out of that dog stock. That's what's happened to MoneyMe. That's what happened to Pentanet. That's what happened to a lot of other companies. And the share price just kept on falling. Share price of MoneyMe is now significantly lower that the day before this really good announcement. It was a really good announcement. I think the company was profitable or something like that. That's why the market rewarded MoneyMe. Share price increasing 64%, and now the share price is significantly lower. It's just amazing. The psychology of the market, of individual investors. Now on to Cogstate. Now this is the share price of Cogstate, just all over the place. Just look at that. This goes back to June 2021. Share price has reached a high of about $2.69 and has fallen all the way down to $1.12 at its low. Share price is moving with shifting sentiment, and the sentiment's shifting just wildly with this company. And we can see that's really starting. The most recent shift in sentiment started on the 20th of February when the share price fell 18%. The next day it fell 14.5%. The next day it fell 27.4%. Then we saw a bounce, which is very normal. Unfortunately, you can see the volume. When the share price rose the next few days on the bounce, the volume was significantly lower. So I'm always looking at volume. If the volume is lower on the bounce, or if the share price increases significantly, and then the volume is much lower when the share price pulls back, that's a good sign. I don't think you can say that with MoneyMe though. So this is telling us, particularly with the volume decreasing as the share price got higher, that there was less interest in this company as the share price bounced. And then the share price has started to fall again because there's no one willing to buy shares in Cogstate. Now, I'm a fan of Cogstate, not a shareholder. I would have been probably interested in taking a position in Cogstate at about $1.20 or something like that. But I want to do more research on this company because obviously there was something that drove the share price of this company down. And this is another example of recency bias. I've already talked about recency bias. I think it was Docusign, and I saw this with a comment. So someone did mention the Cogstate share price is really attractive now because it is significantly lower than it was a few days previously. So on the 17th of February, share price of Cogstate was about $2.35, and then a few days later, the share price was half of that. And you think, well, the share price was $2.35 a few days ago. Now it's $1.15 or $1.20. There's great value in this company right now. And that's why you do see some investors coming interested in a company. But because this company is profitable, there could be some investors out there who see the share price get down to their buy level. I do this on occasion for companies I want to own for the long term. My only question about Cogstate is whether this is a high quality company. I only do that for high quality companies. So when I do see the share price fall to my level that I'm willing to buy some shares, it has to be a high quality company. I don't know if I would assign Cogstate with a high quality tag just yet. Now on to Probiotic. I backed up my shareholder of this company. Actually, I wouldn't call this an ugly chart, but just share price just going sideways when you look at the daily chart. So since really about, keep spinning out. So since the end of 2020, share price just gone sideways. So what I'm waiting for this company, I do have a small position. What I'm waiting for this company, so if you look at the longer term chart, this is a really nice chart going back to 2016. So really good increase in share price. But we do have a situation right now where the share price is just going sideways over the past 2 years. And I found when this happens, when share price is just going consolidating, going sideways, what you want to wait for is a breakout of the share price above the highs. And that high is around about $2 and we'll say about 49 cents. And we can see, just looking at the weekly chart, we have seen share price get up to that level a few times in the past. And every single time the share price wants to get up to that level, we do see a little bit of selling. In fact, that's happened in the past week. You can see the weekly candlestick, share price got up to $2.45, and there was a little bit of selling. That's just traders who see the share price get up to that resistance level at $2.49 and say, well, it's up there now, I'm going to sell. And if the share price breaks out, then the traders become interested of the breakout. You might see higher volume and the share price moves into an uptrend. So with this company, and this is a profitable company, so market cap of just under $200 million, dividend yield of 2.7%, price earnings ratio of 13.3%. You can't see it here because it's under my face, but if you do look at the growth in revenue over the past 5 years, it's gone from 66 million to 182 million. They've made some acquisitions, but really nice growth in revenue, even revenue per share. So this is the reason why I own Probiotic, PBP. And if I see a breakout in the share price above $2.50, I will add to my position. Some people think that's crazy when you say I'll add to my position if the share price increases. It's not crazy. It's just trading. It's the technical signal that this consolidation period has come to an end. Otherwise, if I put some money into probiotic right now, there's an opportunity cost because the share price could go sideways for the next 2 years. That's an opportunity cost. And I don't want to have opportunity costs. I want to make a good trade here for a company I hope to own for the long term. We don't know. Over the next 2 years, share price of probiotic could go sideways or it could increase by 50, 100%. We just don't know. Now to Domino's Pizzas. Was this the worst half-year results of the year? Now it's really looking another Matterhorn. We've got another beautiful Matterhorn. And some people might say Domino's Pizza is a tech company, and I just mentioned earlier that you have seen the Matterhorn sort of what do you call it? A Matterhorn thingy quite often with tech companies. So maybe that's true. Domino's Pizza is a tech company. It's not a food company. I'm not the biggest fan of Domino's Pizzas. That's just me. But the really interesting thing about Domino's Pizza is where the share price is right now at $47. And that's fairly a similar level than when we saw during the COVID-19 financial panic. So $47 could be a possible buy-in position for this company. But if you do take a look at the daily chart, there's just been a lot of selling. So when the share price did fall when they released half-year results, 23.8%, there would have been some people who bought on that day because the share price just fell 23.8%. And they would have, because of recency bias, they would have thought, what a bargain. And the share price just kept on falling. The low on that day was $53.58. Share price now $47. So another 10% lower than the lows on that day. Now, if we go back to the weekly chart, the next support level for this company is, in fact, I'm going to put it right here, is these lows way back in 2019. Yeah, so that's the next support level for this company. That's around about $35, $36. So who knows how low Domino's Pizza share price will fall from here. I wouldn't necessarily say it's an absolute bargain at these prices, but I think if you are really long-term, I'm saying 10 to 15 years, and I do think there is potential that the problems this company is facing right now are just short-term, non-structural problems with their business. So this is just macroeconomic things happening with the overall economy that are affecting Domino's Pizzas. Even though I'm not the biggest fan of the pizzas, I thought when I last had them, they were too small and too pricey. Maybe that's the thing wrong with Domino's Pizza right now. Keep looking at my watch because I want to be finished in 4 minutes. I'm not going to be finished in 4 minutes. There is no way. Myer, this is just craziness. I don't know why investors are buying into Myer. Sure, their results were great, but this is a company, particularly with what's happening in retail and what should happen in retail over the next 6 months, 12 months. This is the sort of company that is going to be highly affected by those decreasing in discretionary spending when it comes to retail. But they did release really good results. Share price absolutely has taken off. Share price now $1.07. Market cap approaching $1 billion. The last time the share price was this high, wait for it. Last time the share price was this high was in 2017. So this is almost a 60 high in the share price. Is it a 60 high? Not quite a 60 high in the share price. So a lot of positive sentiment behind this company. Now, the company did have the new CEO, which has been in that role for maybe 3 or 4 years, maybe even longer than that. Does look like he's doing a good job, but I just am concerned about the business model moving forward. And that's why the share price just has fallen and fallen and fallen, was because of the outdated business model. People just don't want to or won't want to go to these sort of stores in the future. So I think this is just a short-term shift in sentiment, and there is a possibility that this shift in sentiment won't last very long. Maybe it will. Maybe this is the turnaround story of the year on the ASX, Myer Holdings, but I doubt it. Anyway, so for those who have taken position in this company, good luck. This is a nice looking chart. Just looking at the weekly chart here, the daily chart is looking even better. That's a beautiful looking chart. Nice little breakout back in July last year when the share price was about 48.50 cents. So the share price has more than doubled since then. But just beware, retail companies are going to be under pressure over the next 6 months to 12 months. Even though they will be under pressure, I still am a holder of a few. because I'm long-term. I'm thinking long-term. And when it comes to Myer, I'm not sure the long-term picture is exactly there. Now onto a company whose share price actually increased on the Friday. This is exactly what you want to see. You want to see the share price of a company go against the market. And that's exactly what happened. Well, not when the market's up. You want to see the share price go up as well. But John's Lyng Group share price actually rose 0.15% on the Friday, when the overall market was down over 2%. And the main reason behind that is because of the half-year results. When they released on the 21st of January, share price rose 13.2%. This is a situation where the market got it absolutely wrong, because back in, I forget exactly where it was, maybe December, late December, the CEO sold out of some of his shares. And that's why the share price dropped 12%. The market, for some reason, hates when the CEO sells out some of his shares. It's not necessarily means that the CEO thinks the company is in trouble, because we saw that when the company released the half-year results. They were absolutely great results. So even though share price is down a fair bit from the highs we saw back in April 2022, and even though the P ratio is still 44, definitely at 1.15%, this company has the potential for pretty good performance over the next few years, just because of what they are. Some people call this company a construction company. They're not exactly a construction company. They're a little bit different. They have a niche, and their margins are a little bit better than ordinary construction companies. Rant ended. I am a shareholder of this company. In fact, I traded. The reason I bought John's Lyng Group, you can see here. So I will mark when I buy a company sometimes, and I bought John's Lyng Group just because there was a really nice week back in 2021, and I took a position, just a trading position, and then the share price doubled from there. Share price has pulled back, but I do like the long-term thematic of this company, and I changed my position when it comes to this company. So I just bought this company for a trading reason. Now it's for a long-term reason. Now onto Iris, and I just want to show you the weekly chart for this company. I don't know much about what they do. In fact, I've never researched Iris. They have something to do with stock market something, I forget. Anyway, but look, this is a great example of a real strong support level. So if we go look at the weekly chart and go all the way back to 2015, you can see the share price in 2015 and start of 2016 got down to a low of about $8.90. And since then, we have seen the share price get down to that level about 4 or 5 times in the past. And every single time the share price gets down to that level, we see the share price go on a nice little run. Even a nice little run, but a little bit of a run. And the share price right now is right on that support level. It has fallen through. You can see over the past few months, 6 months or so, share price has fallen below that level for a brief period of time, and then a lot of buying comes in. We saw that during the COVID-19 financial panic. Some buying came in when the share price fell below that support level, and we have seen the past week. We saw it again last September, October. Share price fell below $8.90, and we saw buying coming in. We saw it in the past week. So let's have a look at the daily chart very quickly. You can see that buying coming in. So there it is. There was a really bad announcement on 29th of September last year. Share price fell 17%. That was the low. Nice buying came in because of that support level. Traders know $8.90 is a strong support level for this company. And when they see the share price get down to that level, they will buy. But there is potential that that share price will fall below this support level. And if it falls below the support level for a period of time, that support level then becomes a resistance. That's the only fear I would have if I was in Iris right now. From, getting a bit sweaty here, from Iris to Avita. Absolutely amazing what's happened with Avita over the past few months. Really since the start of, say, the middle of January, there was a breakout, a beautiful breakout. This is a great definition of a ragger. So we had a low or high back in August last year. Share price got down or got up to $2.30 and then pulled back. Then the share price got back up to $2.30 in November and then pulled back. And then the share price pulled through $2.30 on strength in the middle of January. You can see the volume. So we need volume. I would prefer volume when we do see a breakout. And then the market tested that support level. So it was resistance, and then it became support. And then the market tested that support level. You can see the share price come back, fell through the support level for a brief period of time, and then we saw some buying. And the share price has taken off. And in fact, share price has risen 20% on this day, 16.8% on the next day, 27th of February, and then another 10%, almost 10% on the 28th. So a lot of excitement in this company. I do remember reading the report that led to this really big shift in sentiment, and it was a good report because the company is expecting really big things in financial year 23. Market cap 510 million, revenue of 49 million. So there is an expectation that revenue is going to be significantly higher in financial year 23, maybe financial year 24. Now on to Pax Group. So let's have a look at the daily. So this is another instance where there is a really strong resistance level. You can see the share price get up to the 150-day moving average back in August last year and then pull back. And we have just seen it again. Share price get up to 150-day moving average and then pull back. Nice run in the share price. Share price went from $1 to $1.38. So 38% return in Pax Group in a very short period of time, maybe 3 to 4 week period of time. But lots of selling has come in because the share price reached that resistance level, which is the exponential moving average, the 150-day moving average, and we have seen 3 big down days. Maybe not big down days, down 4%, down 4%, down 4%. So 3 down 4% days in a row, which is telling me the market was just testing that resistance level, and now we have seen a sell-off in this company, decreasing. Share price decreased from the high of $1.40 back down to $1.21.5. Not a highest quality company on the ASX, by far the highest quality company on the ASX. Almost dismal growth in revenue. You can see revenue has gone from $1.67 billion in 2018 to $1.84 billion in 2022, and almost no profit, $12 billion of profit, $74.5 million in profit in 2018, so decreased margin. That's why share price has absolutely tanked it. If you look at the weekly chart, it's been a disaster. Not quite the Matterhorn, but actually maybe 2 Matterhorns here. So 2 nice little mountain ranges when it comes to Pax Group. Next company is Sonic Health. I wasn't going to include this company because I am thinking of taking position in this company just because of the chart. Another company, just like John Lyng Group, where the share price increased when the overall market was down. Share price of Sonic Health rose 0.3%, and the share price closed at a 7-month high, 6 to 7 month high. Nice shift in sentiment. I think a potential shift in sentiment. I think there is, because this company did benefit from COVID-19. You can see the share price just by looking at the weekly chart. So the share price really took off because they did a lot of testing, that sort of thing. Share price went to a high of $47. Then those tailwinds became headwinds. A lot of that revenue they got from COVID-19 testing has fallen away. And I think maybe the potential of the market overreacted to the downside, just like they overreacted to the upside. And I think potentially the market is now changing its position on this company, changing their perception on this company. And that's why. And also, you can see a really good day on the 16th of February, day they must have released the half-year results. Share price rose 14% on that day, and the share price has increased from that position. And I do like when there is a shift in sentiment, and the catalyst for the shift in sentiment is good financial numbers from the company, or good financial statement from the company, like a profit upgrade. That's what I'm always searching for. So I am thinking about taking a position, trading position potentially in this company. I'm not sure if it's a high quality company. Probably want to go that far. Maybe a borderline high quality company potentially. Now to GWA. Oh, which one will I show you first? Okay. This is another instance where the share price, if we look at the weekly chart here, $1.75 was a really good support level for this company. Share price reached that level back in 2012 and again in 2015 and 16, and then again in the middle of 2022, 14th of June 2022. So that level, $1.75, was a really good, strong support level. So whenever the share price, and we'll go to the daily chart now, so when the share price got to that level, there would be some traders who know support levels who thought, So on the 22nd of February, just before the company released the half-year results, share price was just above that trading level, that support level. So potentially there were some traders who saw it get to that level and thought, I might take a position. There would have been some other traders who said, I'll just wait for the half-year results. If they did release the half-year results on the 23rd, there was a really big down day on the 20th. Maybe they released the half-year results on the 20th. But you can see the share price fell below that support level. Look at that. Share price fell below that support level on the 23rd, down 4.78%, and has struggled to get above. So it looks like that support level, $1.75, is now resistance. Now, this doesn't necessarily mean it's going to be resistance. If the share price moves above it, potentially it was a false breakout of this support level. So now I'm thinking $1.75 might be a resistance level for GWA Group. A nice dividend yield, but that could be a trap because maybe the dividends will decrease. Market cap 453 million, price earnings 11.98. You've got to take some of these numbers with a grain of salt as well, in my opinion. It's raining outside. Ooh. Now on to Lake Resources. Ooh, okay. So Lake Resources, just the daily chart here, and it's really simple. So back in July last year, the share price fell to 57 cents, and then a rebound. Look at that rebound. Went from 57 cents all the way up to $1.60 in a few weeks. Beautiful bounce in the share price after a massive decrease in the share price. Look at that U-shaped thingy, whatever you want to call it. But the share price of Lake Resources, just like a lot of other lithium companies, has been a downtrend for a while, and the share price has just reached those lows we saw back in July, which is not a good sign. But we need to see the share price fall below $1.57 for this support level to be broken. It tried to fall below on the 27th of February and then rebounded. So that's a good sign. I just had a missed call. Anyway, so Lake Resources is looking more interesting just where the share price is right now. Now on to Megaport. Things just keep on getting worse for Megaport. Share price now has fallen below the lows we saw back in June, fallen below $5. Share price in a well-defined downtrend. You can see some really big down days for Megaport. One in April, another one in August, another one in October, another one in January, another one in February, and all those down days, or most of those down days, are because of bad financial numbers in either their Appendix 4C or the half-year, full-year results. That's why the share price has been under pressure, and that horizontal line that I've got, share price just below the share price, or where the share price is right now, if we have a look at the weekly chart, that's a really good support level. It all goes all the way back to 2018. If we go back to 2018, you can see the share price really struggled to get above $4.50. You see it really struggling to get above, and then it broke out in April 2019, and then it kept on going up. So there would have been a lot of people who bought on that breakout, thought the share price would not get back to that level, and the share price is really trying hard to get back to that level. Share price currently is at $4.80. We did see the share price on the 8th of March get to a low of $4.55. So just above or around that support level, and the share price made a nice little bounce. But I think there is potential the share price will fall below that, that support level just because of the amount of negative sentiment in this company. So much negative sentiment in Megaport. 3 companies to go. ReadyTech is a company I have followed a while. Now, there was a takeover bid. The only reason I'm showing this chart, I have a philosophy. When there is a takeover bid for my company, I will automatically sell out. Now, that doesn't work all the time because sometimes there will be more bids and the share price will increase. But a lot of times, the share price will fall because the takeover bid will be pulled or something like that. Seems like that may have happened with ReadyTech because there was a takeover bid on the 1st of November. Share price increased 28% on the day. The share price has fallen since then. In fact, the share price is now lower than the day before the takeover bid. It has fallen from $4.28 down to $3.12. And this is the reason why I always sell out of shares of a company where there is a takeover bid, because the upside, the reward of an upside or potential upside from then on in is fairly low compared to the risk of significant downside. And ReadyTech is a perfect example of that. 2 more companies to go. I've never talked about Weebit. I have never looked at Weebit, but just look at this chart. There's a lot of excitement about Weebit. This company has no revenue. Who knows when they're going to get revenue? Loss of $28 million last year. I do know they're into some sort of tech, and the market's just too excited right now. Market cap of 1.5 billion. If you thought BrainChip was crazy, this is just equal crazy. Beautiful chart though, but it is sort of growing. Share price is growing exponentially. We've seen some really big up days, like 10.3%, 10.3%, 6.9%, 6%, 10.8%. Yeah, so at this point in time, I would be very wary about this company because I'd like to see this company prove whatever they're trying to do. And with a market cap of 1.5 billion, they could make it. And congratulations if they do make it. But there's a lot of risk when it comes to this company. And I'm becoming more risk averse. That's probably the best way to say it. I'm becoming more risk averse. And I'm more willing and only willing, not more willing, I'm only willing at this point in time to put my money in either a trade of a company that is profitable or into a company that is high quality for the long term. I might talk about that in another video. I'm trying to stay out of these sort of story stocks, these sort of concept stocks. But maybe this company will have a lot of revenue in the next year, the next 2 years, and maybe the market will be justified, but there's still a lot of risk because there is potential, a lot of downside risk when it comes to these sort of charts for companies that are producing no revenue. And the last company, Pointerra. Ugly chart. But I think the market is potentially overreacting. The market cap of this company is now down to 67 million. So at one point, the share price of this company got to like 90 cents. 90 cents, which means the market cap back then was about 500 million. You can just see the share price just going down since then. In fact, we have a look at the weekly chart. Well, we won't. Yeah, another Matterhorn. So a lot of interest in this company back in 2020, the later period 2020 into 2021, but the company has released two really negative financial reports. The Appendix 4C, to 31st of January, share price dropped 21.7%, and then the company released their half-year results and the share price fell another. Share price has fallen below 10 cents. I think it did. I thought it was like 9.9 cents. It says 10 cents on TradingView, but really negative sentiment in this company right now. I had a look at Hot Copper, even some of those more dedicated shareholders of this company are getting a little bit annoyed about the management of Pointerra because of the annual contract value, ACV, is how do you say this? The ACV is lagging the revenue or cash receipts by a significant amount. And there is concerns about that among a lot of shareholders, among the market. But if they can turn this around, if management can start proving the business model, a market cap of 67 million is looking enticing, but there is a lot more potential further the share price of this company has to fall from here. So that's it for this video. If you have any questions about any company I have featured in today's video, this should be a fairly long video, just leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.